Welcome to our comprehensive guide on market structure. In this video, we'll break down what market structure means, why it matters, and how it shapes the world of business and economics. Whether you're a student, a business owner, or just curious about how markets operate, understanding market structure is essential. We'll start by defining the term, then move on to explore the different types of market structures, their characteristics, and real-world example. By the end, you'll have a clear grasp of how market structure influences competition, pricing, and consumer choice. Market structure refers to the organizational and other characteristics of a market. It describes how firms are arranged, how they interact, and how much control they have over prices and output. The structure of a market affects the level of competition, the strategies businesses use, and the choices available to consumers. Understanding market structure helps us analyze how markets function and predict how changes might impact the economy. Market structure is crucial because it determines the behavior of firms and the outcomes for consumers. For example, in some structures, a few firms may dominate and set prices, while in others, many firms compete, leading to lower prices and more choices. Policymakers and economists study market structure to ensure markets remain competitive and efficient, which benefits society as a whole. There are four main types of market structure: perfect competition, monopolistic competition, oligopoly, and monopoly. Each type has unique features that influence how businesses operate and how consumers experience the market. In the following scenes, we'll dive into each type, exploring their characteristics and examples. Perfect competition is a market structure where many firms sell identical products, and no single firm can influence the market price. Entry and exit are easy, and information is freely available to all participants. This structure is rare in the real world but serves as a useful model for understanding how competitive markets work. In perfect competition, all firms are price takers, meaning they must accept the market price. Products are homogeneous and consumers can easily switch between sellers. There are no barriers to entry or exit, so new firms can join or leave the market freely. This leads to maximum efficiency and benefits for consumers. While perfect competition is rare, some agricultural markets come close. For instance, wheat or corn markets often have many sellers offering similar products, and prices are determined by overall supply and demand. These markets illustrate how perfect competition can function in practice, even if not perfectly. Monopolistic competition is a market structure where many firms sell similar but not identical products. Each firm has some control over its prices because of product differentiation. This structure is common in industries like restaurants, clothing, and consumer goods, where businesses compete on features, branding, and quality. Monopolistic competition: firms compete by differentiating their products through branding, quality, or features. There are low barriers to entry, so new firms can enter the market easily. Each firm faces competition but can still influence its own prices to some extent, leading to a wide variety of choices for consumers. Think about your local coffee shops or clothing stores. Each offers a slightly different experience, from the taste of the coffee to the style of the clothes. These differences allow businesses to attract specific customers and set their own prices, making monopolistic competition a common market structure in everyday life. An oligopoly is a market structure dominated by a few large firms. These firms have significant control over prices and may collaborate or compete fiercely. Oligopolies are common in industries like airlines, automobiles, and telecommunications, where high barriers to entry limit the number of competitors. In an oligopoly, firms are interdependent, meaning the actions of one firm affect the others. They may compete through advertising, innovation, or pricing strategies. Sometimes firms may even form cartels to set prices together, though this is often illegal. Oligopolies can lead to stable prices but may reduce competition. Major airline companies or car manufacturers are classic examples of oligopolies. A few big players dominate the market, and their decisions on pricing or new products can have a huge impact on the industry as a whole. This structure is common in sectors where starting a business requires significant investment. Monopoly is a market structure where a single firm controls the entire market. This firm is the only provider of a product or service, giving it significant power to set prices. Monopolies can arise due to unique resources, government regulation, or high barriers to entry that prevent other firms from competing. In a monopoly, the single firm is a price maker, meaning it can set prices without concern for competition. Consumers have no alternative choices, which can lead to higher prices and less innovation. However, some monopolies are regulated by governments to protect consumers and ensure fair pricing. Utilities like water or electricity providers are often monopolies in local markets. Because it's inefficient to have multiple companies building infrastructure, one firm is allowed to operate, usually under government regulation. This ensures consumers have access to essential services at reasonable prices. Let's compare the four main market structures. Perfect competition offers the most competition and lowest prices, while monopoly offers the least competition and highest prices. Monopolistic competition and oligopoly fall in between, with varying degrees of competition and price control. Each structure has its own advantages and disadvantages for consumers and businesses. The level of competition in a market structure affects how firms behave. In highly competitive markets, firms must focus on efficiency and customer satisfaction. In less competitive markets, firms may have more power to set prices and earn higher profits, but consumers may have fewer choices. Barriers to entry are obstacles that make it difficult for new firms to enter a market. High barriers, such as large startup costs or strict regulations, can lead to monopolies or oligopolies. Low barriers encourage more competition, as seen in perfect and monopolistic competition. Product differentiation is a key feature in monopolistic competition and oligopoly. Firms try to make their products stand out through branding, quality, or features. This allows them to attract specific customers and gain some control over pricing, even in competitive markets. How prices are set depends on the market structure. In perfect competition, prices are determined by supply and demand. In monopolistic competition and oligopoly, firms have some influence over prices. In a monopoly, the single firm sets prices, often leading to higher costs for consumers. Market structure affects the choices available to consumers and their overall welfare. More competition usually means more options and lower prices. Less competition can lead to higher prices and fewer choices, but sometimes greater efficiency or innovation in certain industries. Governments often regulate markets to promote competition and protect consumers. This can include breaking up monopolies, preventing collusion in oligopolies, or setting price controls. Regulation helps ensure markets remain fair and efficient for everyone. Different market structures can encourage or discourage innovation. In competitive markets, firms innovate to stand out. In monopolies, firms may innovate less due to lack of competition, but sometimes they have the resources to invest in research and development. Market power refers to a firm's ability to influence prices and output. In monopolies and oligopolies, firms have more market power, which can lead to higher prices and reduced consumer welfare. In competitive markets, firms have little market power, leading to better outcomes for consumers. Efficiency in markets means resources are used in the best way possible. Perfect competition is the most efficient, as firms must minimize costs and maximize output. Monopolies may be less efficient due to lack of competition, but sometimes economies of scale can offset this. The potential for profit varies by market structure. In perfect competition, profits are usually low due to competition. Monopolies can earn high profits, while monopolistic competition and oligopoly offer moderate profit opportunities depending on the level of competition and product differentiation. Most real-world markets don't fit perfectly into one structure. Many industries have features of more than one type. For example, the tech industry may have elements of both oligopoly and monopolistic competition. Understanding these nuances helps us analyze markets more accurately. Market structures can change over time due to technological advances, regulation, or shifts in consumer preferences. For instance, new technology can lower barriers to entry, increasing competition. Staying aware of these changes is important for businesses and policymakers. To wrap up, market structure is a fundamental concept in economics that shapes how businesses operate and how consumers experience the market. By understanding the different types of market structures, their characteristics, and their effects, you can better analyze industries and make informed decisions as a consumer, business owner, or policymaker.